Volatility is the fear meter in the options market. When volatility spikes, options premiums rise. When it drops, premiums decline. And if you don't know how to read volatility, that's historical, implied, rank, percentile, you're basically trading blind. And that's because there's a big difference between trading options in low and high volatility environments. And I'm not talking about pennies here. Learning how to play around with volatility can lead to thousands of dollars in more profit. Today, I'm excited to show you exactly how I use volatility to time trades, avoid overpaying for options, and how to find setups with the highest probability of profit in minutes using bar chart. Options traders refer to volatility as the degree of variation in an asset's price over a given period. Or in simpler terms, it's the measure of how much an asset's price is expected to move. Think of it a little bit like an earthquake. The Richter scale measures how strong the earthquake was, its magnitude. Volatility in options trading measures the magnitude of how far a stock could move, up or down. Volatility is critical because it directly impacts options prices. The more the market expects a stock to move in either direction, the higher the option premium become, again, regardless of direction. Volatility is measured in two common ways: historical and implied. Historical volatility, sometimes referred to as realized volatility, is presented as a percentage and is based on the magnitude of the underlying price moves over the last 12 months. On the other hand, implied volatility forecasts future volatility based on the underlying's current price movement. So how does this impact options trading? Well, the higher the IV, the higher the option prices, meaning it's more expensive to buy and more profitable to sell options during periods of high volatility. But wait, this isn't a magic formula for trading options. There's a trade-off. Higher volatility means there's more risk of your options trade moving against you. Even more, the speed at which things can change may even be too fast for you to make necessary adjustments. And that's just the risk of trading options with higher than usual premiums. These days, I've come to think of volatility as the fear meter of the options market. More fear and uncertainty there is, well, it leads to higher volatility, higher premiums, and of course, higher risk. Calmer markets, well, lead to lower volatility, lower premiums, and lower risk. Remember, volatility is constantly changing. Headlines, economic data, earnings reports, geopolitical shocks, and general market sentiment, all of this can drive it up or down. What might look like a perfect trade setup right now could turn into a volatility trap, just like that, leaving you with no time to react. And that's why it's important to understand volatility as a whole, not just the number that you see in your broker's trading portal. Aside from historical and implied volatility, there's also other volatility metrics that you need to know. First, there's IV rank, and this measures the current IV's position compared to the past year, or more specifically, where it sits in the range. Let me give you an example. If IV is high right now compared to the past, well, IV rank will also be high, meaning premiums or option prices will be higher than usual. Then you've got IV percentile, which tells you how often IV has been lower than its current value over the past year. So how do you use IV rank and percentile in the context of a trade? Well, IV rank helps you identify extreme volatility conditions, while IV percentile tells you how frequently those conditions have occurred. There's also IV over H, which is sometimes referred to as implied volatility versus realized volatility. A value close to 1 suggests that the options market is pricing in future volatility roughly in line with recent historical or realized moves, indicating a balanced environment where neither buyers or sellers have a strong edge. High IV-HV ratios usually suggest options are overpriced and better for selling, while lower ratios mean cheaper premiums. So how do you use volatility for trading? Well, right off the bat, in general, Higher volatility favors sellers, while lower volatility is better for buyers. But it's actually a touch more complicated than that. In order for you to be successful in your trade, we need to consider where volatility is headed, where it currently sits within its 1-year range, and how often it's been there. In other words, volatility trend, IV rank, and IV percentile. It's a lot of numbers, and I get it. Not everyone has the time to sit down and calculate or evaluate these values. Thankfully, bar chart already does all the work for you. Through its new P&L charting feature, you have access to every volatility metric you may need to consider a trade. To get to the new P&L feature, go to barchart.com if you're not already there yet, and just search for any stock. Let's say we use Palantir in this example. Palantir has been in the news a lot. The stock has skyrocketed over the last 12 months and continues to defy logic. And say you want to get in on the action by buying a call on Palantir. Well, you can go to the left-hand navigation panel and click on long call/put under option strategies. There, you'll immediately see a list of potential long call trades for the closest expiration date. You can change the expiration date by clicking on this dropdown. And for now, let's just keep it unchanged. To access the P&L charting feature, click on the Profit and Loss chart button right here, or the charting icon between the price and the expiration date. And then you'll see 5 tabs: Profit and Loss, Greeks, Expected Move, Volatility, and Trend. All these display critical information that can help you succeed in trading. For now, let's stick with the 4th one, Volatility. And immediately, you'll see the IV rank gauge, the horizontal IV percentile plot, and numerical volatility values at the bottom. You can see other values like the 5-day, 1-month, and 3-month volatility, and the lowest and highest volatility values in the last 52 weeks. But the best features of the Volatility tab, I think, are the interpretations. Interpretations can go from very low to very high. It can also show if there's notable movement in volatility, whether it's rising or falling. If the 5-day average IV is at least 5% lower than the 20-day average, the implied volatility over historical volatility ratio is below 0.91, and IV is falling. So it signals a decline in volatility. On the other hand, if the 5-day average IV is 5% higher than the 20-day average, and the IV-HV ratio is above 1.09 with a rising trend, while volatility is increasing. As we can see here, Palantir's volatility is rising. Its IV rank is 41.67%, its IV percentile is 62.8%, while its current IV is 68.06%. Based on the data, IV is above average, but not at extreme highs, and has been lower than it is now for more than half of last year. However, IV is climbing, which suggests that there's growing interest, or at least a little uncertainty around Palantir, potentially ahead of its upcoming earnings. And if we switch over to the Expected Move tab and check the graph, we'll see that yes, there is indeed an upcoming earnings report which can increase volatility. As you can see, every metric you may need for volatility is right here. But how do you use it in a real-world trading environment? Well, it's best to know what volatility metrics are good for what strategies, and let me show you. Let's start with long options. Buying option contracts is best done when volatility is low, but rising. Perhaps when IV rank, and IV percentile are all below 50%, but with an upward bias. This allows you to spend less on the trade setup right now and potentially earn more as volatility spikes. This strategy applies to long calls and puts, which you can sell further down the line, ideally for more money than you bought them for. Of course, the risk here is that if the stock price moves against you, say you have a long call on Palantir, but the stock price goes down instead, well, that higher volatility is not going to do you any favors, as the premiums will also move down just as fast. For short option strategies like covered calls or cash-secured puts, higher but falling IV usually works best. That means IV, rank, and percentile above 60 or 70%, as these trade setups have the potential for richer premiums, and the falling IV will eat away at the options values, allowing you to buy them back for cheap or let them expire worthless. And these ideal volatility scenarios extend to more complex trading strategies. For example, credit strategies like bear calls, bull puts, and short iron condors work well when IV is high and falling, while debit strategies like bear puts, bull calls, and long iron condors are better when IV is low and rising. Whichever strategy you choose, of course, will entirely depend on your outlook. Now, how do you find high or low volatility trades? Well, Bar Chart has a few quick and easy sections that you might be interested in. So let's go back to the homepage, then click Options here at the top, and you'll see these four options under volatility: IV rank and IV percentile, implied versus realized volatility, highest implied volatility, and percent change in volatility. Each of these sections allow you to find underlying assets and trades that display certain volatility traits that may fit your preferred strategy. Let me give you an example. Say you're looking to buy a call. You can start by clicking highest implied volatility here, and then going to the lowest tab at the top. Here you'll see assets with the lowest implied volatility in the market today. I also like to consider volume, as higher volume means more liquidity. So I'll click the volume column header, and the list will be arranged from highest to lowest volume trades. And there you have it. The top 5 assets are Microsoft, AGNC, Apple, Altria, and Caterpillar, all very well-known companies, and you immediately get suggested strike prices, bid and ask spreads, implied volatility, and delta values. So let's say you're thinking about buying this at-the-money Microsoft call with the $505 strike that expires on August 15th, or in about 37 days from the time of recording. The premium is $15.60, so with this trade you'll want volatility to rise so that the premium rises as well. Well, fast forward a little to say August 8th. It's about a week before expiration, and the stock has moved up from $503 to $520. And your option? Well, it's now worth $19.05. If you sold it today, you'd make $3.45 a share, or $345 per contract. Now that you know how to look for trades, let's discuss the most common mistakes that new traders make when trading around volatility. First, it's mistaking IV rank and IV percentile. Remember, IV rank shows you the relative position of the asset's current IV in a historical context, while IV percentile indicates the percentage of time over the past year that IV has been lower than it is right now. So, always use IV rank to spot extremes and IV percentile to spot consistency. Next is buying and selling options at the wrong time. When going long, like buying a stock, you want to buy low and sell high, right? Well, the same works for options. You want to buy options when IV is low and sell options when IV is high. Entering long positions when IV rank, and IV percentile are already through the roof means you're overpaying. And selling options when IV is too low means you're getting lower premium while being exposed to the same risk. Next, and this one's really important, is applying the same volatility yardstick for all trades and ignoring natural volatility shifts. I'm talking about applying hard rules to your trading, like all IV above 50 is immediately high, or I'm not buying options with more than 30% IV. As I said earlier, IV is a moving target, and it has complex relationships with other option metrics, like Greeks, time to expiration, market events, the stock's price movement, and of course the company itself. What's high IV for Coca-Cola, a typically non-volatile stock, may be completely normal for Tesla. And don't forget that volatility can expand after entry, so setting rigid thresholds can cause you to miss out on profitable opportunities when conditions shift. Trading around volatility isn't just for the pros. It's a skill that anyone can learn. By mastering tools like IV rank, IV percentile, and IV HV ratios, well, you can better time your entries, choose the right strategy, and avoid some of the most costly mistakes that options traders make. Whether you're selling covered calls during periods of high IV or buying long calls during periods of low IV, knowing the context gives you a serious edge. And thanks to platforms like Barchart, you don't have to do the heavy lifting. All you need to do is click a couple of buttons and you're there. But what's theoretical knowledge without actually going out and making the trade? So I challenge you to hop onto your favorite broker's platform, sign up for a paper trading account, and test what you've learned here today. Sell options when IV is high and buy them when it's low. Then monitor the changes in IV, IV rank, and IV percentile, and of course the stock's underlying price action. And then see how those volatility conditions affect your P&L. Then, when you're good and ready, consider trading with real money. After some time, I think your wallet will thank you for it. Well, that's what I've got for you today. If you found this video helpful, let me know in the comments below. And while you're there, don't forget to like and subscribe so others will find it as well. Thank you so much for watching, and I'll see you next time.